Hey everyone, Brian Bogner along with Greg Towner here, and we're excited to talk to you today with our 20-minute market breakdown. And we're going to talk about two things today. First, we're going to take a topic that you hear us talk about a lot in this show. We talk a lot about investor behavior, right? Which gets into the emotional conversation about investing. And we're going to highlight this because we truly believe that when it comes to the markets right now and the news cycles and everything like that, there is a lot of emotion, and then there's a lot of things driving things right now. And so we want to kind of give you our thoughts on how best to navigate through that. And then secondly, we're going to talk about some things happening today. Fed's meeting in Jackson Hole and what's going on and interest rates and things like that. And we'll kind of wrap that up here at the end of the 20 minutes. So buckle up and get ready, and let's go ahead and dive into this. Okay, Greg. Obviously, investor behavior. I think we talk more about this probably than anything else. And
Right.
so let's start with why are we talking about it again today?
Yeah. I mean, the reason we talk about it in general so much is because we've both seen it so much in our careers impact
Right.
investors over and over. I mean, we talk about how so much has changed in the investing landscape throughout our careers, but the two things that have definitely not changed are fear and greed, right? Those
Mhm.
just always exist and likely always will. But more specifically, why we're bringing it up today is we're always interested in the different studies that come out that look at different ways to measure the behavioral side of investing. And just here in the last week or so, Morningstar came out with their latest study called Mind the Gap. And it's one of our favorites. There's a number of them out there. That's one of our favorites. And what they looked at is a 10-year look at all mutual funds and ETFs that have a 10-year track record, most recent 10 years. And how did the investors themselves in those funds performance compare to the funds themselves? So, for example, the average investor invested in those funds and ETFs over that 10-year period returned 7% per year. Okay. But the funds themselves returned 8.2%.
Wow.
So the investors only achieved about 85% of the actual potential returns, which is a huge difference, particularly over time with compounding. And even worse, if you drill down into the data more, some of the more aggressive funds, some of the more sector-based funds are even worse. And keep in mind, I said this is just for 10 years. So some of these more aggressive funds that have come out in recent years are not yet in this. And a lot of people are trading in those. So
Right.
probably safe to assume it's even worse in those funds. So big behavior gap. They call this study Mind the Gap.
Yeah. So there's a behavior gap based on there's a gap based on investor behavior.
Right.
Why the big difference? So why are we seeing this big difference between those two returns?
Yeah, I mean, a few pretty obvious reasons. I mean, of course, over trading. I mean, trading is always a thing throughout history, but I think this day and age, everybody seems to be gambling and speculating as much, if not more, than investing. So people overtrade. They're chasing headlines, whether it's in the news or in social media or what have you. They're not, investing. They're just like, "Ooh, that sounds good. Let me just dive into that." Well, first of all, it may not even be true, and
Right.
second of all, if it's in the headlines, it's long factored into the
Mm.
market. But obviously, the big reason that this is the case or that this gap in the behavior is simply due to behavior itself. Like I said, fear and greed don't change. So, let's go back over time when the market dips a lot and people are getting really nervous and scared. They start to sell out of their funds and ETFs and positions. When enough people do that, that inevitably marks the low. Market rallies back, then they see everybody making money again. They get in and chase it, and the greed gets them in. So it's basically the in and out, the behavioral side of it is that gap in the behavior.
Right. I think along those lines too, it's this idea that we have the mental acuteness to be able to pick the bottom and pick the top. You're right. And pick these ideal areas, which is well, flat near impossible to do,
Yeah.
right? But for some reason, right, because there's such a low barrier entry to investing, there really is. You just got to open an account, put some money in it, and you can now invest. There's such a low barrier that we tend to think, oh, well, we can figure this out. Can't be that difficult. Can't be that hard. So what do we do about it? How do we overcome this issue?
Yeah, I know for us at Parallel, we've created a number of different steps involved in our process
Hmm.
to try to reduce the likelihood of mistakes on the behavioral side, not only by our investors, our clients, but by us too.
Right.
So, I mean, for starters, we're big believers. Another thing that we talk about a lot is quality. Particularly when you're talking about our individual stock process, it starts very much with focusing on high quality because, again, back to academic studies, they show that high quality tends to be less volatile, particularly during those important down periods of the market when people kind of have these behavioral mistakes. So we
Right.
want a portfolio that's less volatile. And then sometimes you just have to go back to the absolute basics because they are so important. Diversification. We know a lot of people, we see a lot of portfolios come to us from outside our firm and they say, hey, Brian, can you take a look at this portfolio? Am I diversified? And you're like, well, you own six large cap US growth funds.
Right.
And
Right.
so, no, they're all correlated. So, truly diversified portfolio is a way to help reduce some of the behavioral gaps.
Well, let's just park on that for a second because I
Yeah.
do think we spend, at least with folks that I talk with, I do talk a lot about diversification. And because again, this gets back to the chasing headlines, right? They see
Right.
these unicorns or they see these single things go up and like, well, why aren't we doing that? Well, that's not diversified. I mean, diversified means we're never going to be at the very, very top. But guess what? We're never going to be at the very, very bottom. And so we, what I think happens a lot of times is we train our minds to think, well, shoot, I just need to own these things and I could be making all this money. And again, over time, I think what people forget is things build, 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 build over time. But when they correct fast and hard. You can see this historically. Part of the problem, though, right, is that we've just not seen any type of meaningful correction, I would say, in a while that's done that. And so what happens? We get lazy and that greed starts
Yeah.
taking over, right? And things like that. And we think, I don't need to diversify. I just need to own these things because these things are outperforming everything else.
Right.
And but I think it is very important. You got to be able to wake up in the morning and say it's okay, right? If these things are high flying or whatever they're doing, yeah, I'm not there, but I've got a great portfolio here that's still meeting my needs. It's still achieving what I need to achieve. And with this diversification, it does help protect to the downside.
Yeah, and in fact, I mean, right now as we speak, we're on the second day of a little mini rotation in the market where some of these super high growth
Right.
type securities are all getting hammered.
Right.
But if you have sprinkled in some other types of portfolio positions, you're not doing nearly as bad as if you own all the super aggressive things right now. So
Yeah. And even a step
diversification.
further than that, right? Talking about international markets has not been very fun to do. I'd say in the last 10 years,
Yeah.
15 years, we've not been talking about international markets. But guess what's happened, right? This year is they're actually performing well. If you've got no exposure there,
Yeah.
you're not participating in that. So yeah,
Yeah.
good point.
Well, getting back to what else that we do to help try to control the behavioral side of things, specifically here at Parallel, we follow what we call a core and satellite approach.
Hmm.
So most of our portfolios own a number of core positions, up to roughly three-quarters of the account are
Right.
core holdings. We kind of think of that as almost a buy and hold type positions. Yes, we evaluate them over time. We may trim, we may add, we may even occasionally sell them, but they're really good, solid positions we like for the long term.
Right.
And then we supplement that with satellite positions that we think have potential for outsized growth. Of course, we know with the potential for growth, sometimes they're a little bit more volatile. That's why they're a smaller position. But importantly, this also ties in closely with our risk management strategy that helps us reduce volatility as well, right, Brian? So on the risk side, if one of our core positions hits one of our risk measures, we're going to do a full evaluation. We may sell it, but oftentimes we'll add more to it because it's just a short-term noisy
Right.
incident. Whereas our more satellite positions, we're much more apt to step aside and look for other opportunities. So core and satellite combined with risk management. And then I would say the last thing that sometimes people overlook, and we're doing it right now, and we do it in our monthly
Yeah.
viewpoint, and we do it when you meet with your clients,
Right.
messaging to clients, talking all about the emotions and the behavior a lot, letting them know, hey, this is normal. Don't be ashamed of, having emotions about investing.
Mhm.
Our goal is to try to reduce them for you, not to just magically say, hey, don't have emotions. That's just not realistic. So we try to talk about it a lot because of this reason.
Yeah, we try to be very active. We also try to comment. appropriately on things that are happening, right? Because what ends up happening a lot is the headlines, and you hear us say this a lot, the headlines will paint a narrative. 9 times out of 10, whatever that narrative that the headlines is painting are not what is actually driving the market or driving returns or things like that. There's other things happening. Okay, so that's what we are trying to do. We're trying to cut through a lot of this noise, cut through a lot of this stuff, and say, hey, these are the things that really matter. So let's go ahead and do that. All right. Let's talk about what's happening right now today. The Fed
Yeah.
is in Jackson Hole for their annual their annual shindig with all these, I don't know, I guess movers and shakers in the financial world, and it is affecting the markets. So let's talk a little bit about that and how it affects interest rates and what's going on.
Yeah, absolutely. I mean, the big annual Jackson Hole meeting in Wyoming is coming up here in a couple of days, probably about the time that this video actually gets released. And basically, it's just a big meeting slash party of central bankers from all over the world that come to this great place in the summer to go fishing and hiking and
Right.
probably drinking and what have you. But there are some important speeches, particularly from U.S. Fed Chair Powell. Some years the speeches, aren't too don't matter that much. But this year, this one's really being talked about. And that's why we're bringing it up, because it almost feels like the Fed is almost getting towards into the mainstream for
Yeah.
different reasons. And we wanted to kind of bring this up. It's going to be the investors are really going to pick apart what he says here because they have a meeting in just a few weeks where they're going to decide if they start to cut rates or not. And let's talk about what the Fed's objectives are. Sometimes people lose sight of that. They really have two mandates, right?
Right.
They're trying to keep the job market healthy, and they're trying to keep inflation moderate. And so right now, the last two, three jobs reports, we've seen that kind of worsening a little bit. And maybe some would say more than a little bit. And so that would lead the Fed to cut. And they've said, hey, we'd probably be cutting right now if it wasn't for our concerns around the next part, inflation, particularly as it's tied to the tariffs. So inflation numbers, they're not crazy, but they're kind of a little bit sticky here. And you kind of have to wonder if there's more in the pipe coming. Fortunately, there's some areas offsetting the inflation. Housing is weak. That's helping the inflation numbers. But bottom line is the Fed is going to be talking here later this week. The market will be watching it closely. Yes, in nature, it's just shorter term noise that probably most people could and should avoid. But at the same time, it is fairly important. And we think most likely they'll probably do a quarter point cut next month, but it's far from guaranteed. So we'll be listening to it closely as well.
And the reality is, if they do a quarter point cut next month, it's a quarter point. It's
Yeah.
0.25%, right? And again, it's just on the short end of it's just on the overnight rate, the very, very short term interest rate in the yield curve, right? Because what
Right.
really is affecting us in terms of mortgages and the things that we, car loans and mortgages and things when we borrow money, it's that 10-year note that is being traded by buyers and sellers and things like that. And the Fed, the influence of this Fed rate that everybody talks about, and I think, and I've seen this a lot when I talk to people. They just think, well, the Fed's cutting rates, so my mortgage, if I wanted to refinance my mortgage, it should go down, and a lot of times it doesn't, because
Right.
again, in the longer end of the curve, it's just important to understand that. So even if they cut in September, it's not necessarily the cut I think that we're looking for. It's their wording, right? It's what they're going to
Yeah.
say. It's how they're going to view and what they've seen in the data and what they're going to be looking at over the next year and things like that that really matter.
Right.
Um, all right. Well, good stuff, Greg. This is, I love it. I love it. We're talking about some current things. We're also talking about investor behavior, which obviously it's a topic we're very passionate about. What recommendations do you have for us this month?
Yeah, just one here, and it ties in with what we've been talking about. You asked me about, hey, what can we do on the investment side to help control behavior? Well,
Yeah.
what can individuals do beyond the investing side? And to us, it comes back to something else that I know we've talked about in the past. Try to refine and reduce the amount of sources that you get information from. So less news flow and refine it so that you know it's coming from, a factual source so you're not as influenced by some crazy headline that may or may not even be true to do something in your financial world that would probably end up being a big mistake. So refining your news sources.
Well, Greg, I only get my news from Instagram and TikTok. So what I hear you saying is that I should I'll just eliminate TikTok and then I probably will be good just on Instagram.
It's not just the absolute number, but it's refining the quality of them too, you
Oh,
know.
okay.
Remember that word factual I had in
Yeah.
there too. So
Yeah. Yeah, no, and I think that is such great advice. Because there are, I mean, the reality is, and especially with AI now, they can just pump out stuff. I mean, there's people that want to get clicks. That's all they care about. And by the clicks that they get paid. So they're implementing AI, which is just running in the background constantly, and they're just creating these headlines and creating stuff and pumping it out on social media and pumping it out on these things. And there is, I mean, I know this word fake news gets overused a lot, but there's a ton of fake news out there.
yeah,
And what does it do? It's all being crafted in a way to really just do one thing, and that's create an emotional response. If it creates an emotional response out of you, you will likely click it, you'll likely check it out, you'll likely go look, it'll get eyes, and that person that created that emotional response gets paid money. And that is the system that is working constantly, right? So then if you take that news and decide to make investment decisions or decisions on your life, right? Now you've taken an emotionally charged thing and now you're making another emotional decision to make an investment on your life. And
right.
that's why my recommendation is this is you need a plan. You need a solid plan. Because what a plan does is it gives you a roadmap, it gives you a guidepost, it gives you something that you're shooting for. And not only that you're shooting for, but in the journey to get there, it's giving you a path to get there. Because what's going to happen is something's going to come along and want you to stray from the path, and it's going to give you that guidepost to come back and say, no, 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 no. This is the direction I'm going. This is the plan here. Now, there are times when you shift the plan a little bit, but guess what? You have something that you can now shift. And there's data and there's facts and there's things like that that you can help do that. So it's important to be successful financially without a shadow of a doubt. You have to have a plan. I mean, if you look at yourself as a business, no business does well without a business plan. It just doesn't, right? You don't just
Right.
show up one day and open the doors and like, I think we're gonna offer this now today, and I guess we'll charge this much. I don't know. Let's see how it works out. No business like that's going to succeed. So you need a plan. We certainly here can help you build a plan for your financial life and get you on a good path to accomplish the things that you want to accomplish. So if you have any questions about anything we talked about today, please reach out, parallelfinancial.com. You can shoot us an email as well. But thank you for listening and have a wonderful, wonderful rest of your day.